Something fundamental shifted in the British housing market this year, and most people are only just starting to feel it. Not another boom-bust cycle, not another political promise about affordable homes. This is different. 5 forces have quietly converged, and together they're rewriting the rules of who gets to own property in this country and who doesn't. If you own a home, rent one, or you're trying to scrape together a deposit, what's unfolding right now will determine your financial future more than almost any decision you make yourself. And here's what makes this so dangerous. Each force looks manageable on its own, but they're not operating independently. They're feeding into each other, amplifying, creating a system that's rapidly moving beyond anyone's control. By the time you finish this video, you'll understand exactly what's changed, why it matters to you specifically, and what it means for the next decade of British housing. Let's start with the bombshell that barely made the news. Back in March, the Financial Conduct Authority dropped new guidance that fundamentally altered who can borrow money to buy property in Britain. Since the 2008 crash, every single mortgage application has been torture-tested. Banks didn't just check whether you could afford today's payments. They ran doomsday scenarios. What if interest rates suddenly spiked by 3 or 4 percentage points? What if you lost your job? What if the economy collapsed tomorrow? The logic seemed sound enough after watching millions lose their homes. Protect borrowers from overextending. Protect the financial system from another meltdown. Sensible, right? Except we're now in 2025 and interest rates have been falling. Yet lenders were still stress-testing applications as though rates were about to explode upward. They'd take the reversion rate, that punishing rate you get dumped onto when your fixed deal expires, then add extra margin on top of that just for good measure. In practice, this locked thousands of perfectly capable buyers out of the market. People who could comfortably afford their mortgage at actual market rates couldn't pass these apocalyptic scenario tests. The FCA finally stepped in and told lenders they had far more flexibility than they were using. Test based on realistic 5-year projections, not worst-case fantasies. If rates are falling, your stress tests need to acknowledge reality. They also reminded banks about their consumer duty requirements, which translates to stop designing lending criteria that unnecessarily exclude people who can genuinely afford to borrow. Then July brought an even bigger shift. The FCA simplified the entire mortgage regulatory framework, stripped away outdated red tape, made it substantially easier for people to switch lenders and adjust their borrowing terms. Remortgaging became more streamlined. You can now accelerate mortgage repayments without drowning in bureaucracy. You can have preliminary discussions with lenders without triggering full regulatory advice processes every single time. On top of this, the loan-to-income flow rate restrictions changed. Only lenders issuing over $150 million annually must follow the rule capping high loan-to-income mortgages at 15% of their total lending. Smaller lenders got exempted completely. What does this mean in practice? More lenders can now offer 5 or even 6 times your salary instead of the traditional 4 times income cap. Plus, there's a new government mortgage guarantee scheme helping lenders approve buyers with smaller deposits. So here's the question everyone should be asking, but isn't. Is this genuinely about helping people afford homes, or is this about propping up property prices? Because when you make borrowing easier, you don't necessarily improve affordability. You increase demand. And when supply remains constrained, that demand doesn't drive prices down. It pushes them right back up. The government and regulators desperately want growth, want activity, want transactions flowing through the system. But growth built on expanded credit has a rather nasty track record of ending in disaster. We've watched this film before, haven't we? The trouble is, they might not have any choice, because while lending rules were being quietly loosened, something else was happening that should have triggered alarm bells across Westminster. Rightmove and Zoopla are both recording the highest volume of properties listed for sale in over a decade. Listings jumped 10% year on year, which sounds like fantastic news for buyers. More options, more competition among sellers, better negotiating power. Except there's a critical problem: demand only increased 4%. That gap is hugely significant. Sellers are now chasing buyers rather than the reverse, creating a completely different market dynamic than the pandemic feeding frenzy. Zoopla's forecast predicts house price growth will slow to between 1.5% and 2% for 2025. When you factor in inflation, that's basically flat. Some regions might see marginal gains, others slight drops, but the overall picture is stagnation. So why are so many people suddenly listing their properties? It's not because market conditions look attractive, it's because they have absolutely no choice. Remember all those buyers who locked in incredibly cheap mortgage deals during 2020 and 2021? Rates were sitting at 2%, sometimes lower. Those fixed-term deals are expiring right now, and homeowners are confronting a brutal reality. Their monthly payments are jumping 30%, 40%, sometimes 50%. Thousands of households simply cannot afford to refinance at current rates, even with the relaxed lending rules we just discussed. So they're selling instead. This isn't a trickle, it's a tidal wave, and it's just beginning. Estate agents nationwide are witnessing the same pattern. Motivated sellers, realistic pricing expectations, extended time on market. Properties that sold within days during the pandemic now sit for weeks or months. Buyers have more leverage than they've had in years, but only if they can actually secure mortgage approval and stomach the new rates. The supply surge should theoretically be positive, but it's a symptom of financial distress, not market health. And here's the thing, the government understands this perfectly. That's precisely why they're so eager to loosen lending standards, enable people to borrow more money, push additional buyers into the market. Because if they don't, if demand stays weak while supply keeps flooding in, prices don't just stagnate, they start falling. And falling house prices terrify policymakers more than almost any other economic scenario. Property wealth underpins consumer spending, finances retirement plans, backs loans throughout the entire economy. A crash doesn't just devastate homeowners, it threatens the whole system. But while everyday sellers struggle and compete, a completely different group is making calculated moves that most people haven't even noticed yet. The renters' rights bill and escalating tax pressure are driving landlords out of the market at unprecedented speed. On the surface, that sounds brilliant. Fewer landlords competing for properties means less competition for first-time buyers, correct? Except it's nowhere near that simple. Short-term rental supply is plummeting, which means rents are climbing even higher. Long-term, the landlords exiting aren't the ones tenants should want to lose. The government commissioned the English Private Landlord Survey, published just this past December. This wasn't some partisan think tank propaganda. This was neutral, statistical, government-funded research examining how different landlord types actually operate. And the findings are deeply uncomfortable. Large landlords, those owning 5 or more properties, are twice as likely to have evicted a tenant within the past year. They're significantly more likely to increase rent between tenancies or during renewals. 75% of large landlords raised rent for new tenants. 63% increased it for renewals. They adjust rent based purely on market dynamics. No emotion, no flexibility, just spreadsheets and algorithms. Small landlords, those with just 1 or 2 properties, are far more likely to hold rent steady, especially for long-standing tenants. They're often emotionally invested, more flexible, more willing to accommodate tenants facing temporary difficulties. And according to the government's own data, these small landlords are the ones planning to exit. Increased regulation, reduced tax relief, uncertainty surrounding the renters' rights bill, those are their top reasons for leaving. Who's staying? The major players. Those with 5, 10, 50, 100 properties. The ones statistically more likely to evict, more likely to maximize rent, more likely to treat tenants as line items on spreadsheets. So while the stated objective is protecting renters, the actual policy outcome is pushing out statistically better landlords and retaining the ones tenants are most likely to experience problems with. This is the identical pattern playing out across every industry. Independent coffee shops crushed by Starbucks, family-run chip shops replaced by soulless corporate chains, black cab drivers displaced by Uber's algorithm. Not because the big players deliver better service, but because they can handle regulatory complexity at scale, absorb compliance costs, and optimize through systems. What gets lost? Personal service, flexibility, local relationships. That's exactly what's happening in rental housing right now. This legislation will worsen wealth inequality, not solve the housing crisis. It's consolidating rental property into fewer, wealthier hands. Corporations, institutions, and large portfolio landlords are expanding aggressively while ordinary people get squeezed out. And that consolidation is happening faster and more ruthlessly than most people realize. We're no longer just competing with everyday landlords or small-scale investors. We're competing with BlackRock, Lloyds Banking Group, Granger, Legal & General. These aren't companies dabbling in property as a side venture. They own thousands upon thousands of homes, not scattered individual purchases, entire developments. Whole streets purchased before they even reach the open market. BlackRock has gone so far as to acquire stakes in brick manufacturers. Let that sink in for a moment. They're not just buying finished homes, they're controlling the supply chain, the literal building blocks of UK housing. That's their level of confidence that this market is worth dominating long-term. Blackstone, another massive player, is acquiring railway arches, land banks, anything with development potential. Why? Because housing has become one of the safest, most profitable investments globally. Inflation drives rents upward, debt remains fixed or gets cheaper in real terms. People always need somewhere to live regardless of economic conditions. Even when everything else collapses, people pay rent. They must, it's not optional. These corporations understand something fundamental that most individuals completely miss. Housing isn't primarily shelter anymore. It's a financial asset class, and it's too lucrative to leave in the hands of ordinary people. Remember Maslow's hierarchy of needs from school? Food, water, shelter at the foundation, the absolute essentials for survival. Corporate landlords recognize they're providing one of those essentials, which means demand is completely inelastic. Tenants cannot simply decide not to rent. They cannot boycott or shop around indefinitely. They need a roof over their heads, and they'll pay whatever the market demands. That's why institutional investors view UK housing as an absolute goldmine. This shift fundamentally transforms the game. When your landlord is an individual, there's space for negotiation, for human understanding, for flexibility during hardship. When your landlord is an algorithm optimizing shareholder returns, you're just a data point. Rent increases because the model dictates it should. Maintenance gets delayed because it impacts quarterly profits. Evictions happen faster because there's no personal relationship creating friction in the process. The buy-to-let exodus isn't creating opportunities for regular buyers. It's creating a feeding frenzy for institutional capital. And once these corporations control enough housing stock, they don't just control shelter. They control a massive portion of household income, consumer spending power, and economic stability. That concentration of power should deeply concern everyone, whether you rent or own. But there's one more force at play that could dwarf everything else we've discussed. HMRC collected almost $15 billion from stamp duty last year, and that's despite transaction volumes being significantly down. The tax revenue from property is enormous, and the government knows it. But behind closed doors, think tanks and policy advisors are advocating for something far more ambitious. A land value tax that would replace both council tax and stamp duty. Leaked proposals suggest a new levy specifically targeting properties worth over £500,000. If that sounds like it would only impact the wealthy, think again. In London, you'll find two-bedroom flats selling for £500,000. Throughout the southeast, ordinary family homes are well above that threshold. This isn't about taxing oligarchs and mega mansions. This is about extracting more revenue from middle-class homeowners who've watched their property values climb, not because they're wealthy, but because the market went insane. The political appeal is transparent. Property wealth is concentrated among older voters who already own homes. Younger voters locked out of ownership are far more supportive of taxing property wealth. It's a tempting way to raise revenue without touching income tax or VAT. But the consequences could be absolutely seismic. Homeowners above the threshold would face annual bills potentially worth thousands of pounds. Some would be forced to sell. Others would watch their retirement plans disintegrate. The southeast property market, already under pressure, could face a sudden correction. Nobody knows exactly what form these tax changes will take or when they'll arrive, but the trajectory is crystal clear. The government needs revenue, and property is one of the few areas left with substantial untapped wealth. Stamp duty already generated $15 billion in a slow market. Imagine what a comprehensive land value tax could extract. The danger is it triggers a downward spiral. Forced sales increase supply. Prices drop. More homeowners find themselves in negative equity. More forced sales follow. It's a feedback loop that's incredibly difficult to stop once it starts. And here's what makes this entire situation so precarious. These aren't 5 separate problems. They're interconnected, feeding into each other in ways that amplify every individual effect. Easier borrowing props up prices so sellers can exit without crashing the market. The landlord exodus creates opportunities for institutions to consolidate power. Tax changes could force additional sales, giving corporations even more buying opportunities at distressed prices. Everything points in one direction. Housing is being transformed from something people own into something people rent from massive corporations. The UK property market hasn't just shifted in 2025, it's been fundamentally restructured. And most people are only just starting to understand what that actually means. The question isn't whether you approve of these changes. The question is whether you understand them well enough to make intelligent decisions for your own situation. Because pretending this isn't happening won't protect you. Ignoring it won't make it go away. The only thing that gives you any power in this new landscape is understanding exactly how it works and who it's designed to benefit. These forces are already reshaping your financial reality. Whether you're trying to buy, struggling with your mortgage, renting and watching your money disappear, or sitting on property wondering what comes next, this affects you directly. The more people who understand what's really happening, the more pressure we can apply to policymakers to actually fix the system instead of just propping it up for the benefit of corporations and institutions. What happens next affects all of us. Knowledge is the only real advantage we have left. If this breakdown helped clarify what's actually going on, share it with someone who needs to understand. The more of us who see through the noise, the harder it becomes for these changes to happen quietly. Subscribe if you want to stay ahead of what's coming next, because this story is far from over. What we're watching unfold right now is just the beginning.